Imagine needing access to your money and not being able to get it. Not because you made a bad investment, but because the structure of the investment does not allow you to withdraw when you need to. In 2026, liquidity is quietly becoming one of the most important risks in investing. Most people focus on returns. Serious investors focus on risk. But sophisticated investors focus on liquidity risk. And right now, many portfolios are exposed in ways investors do not fully understand. Today, we are going to break down what a liquidity trap really is, why it is happening in 2026, and how to structure your portfolio so you are not frozen when flexibility matters most. Before we break this down, a brief note on who we are and how we approach risk. At ATN, we help everyday investors access private, institutional-style trading systems that used to be reserved for hedge funds and ultra-high net worth individuals. The model itself is hybrid by design. Automation handles execution and monitoring around the clock, enforcing rules consistently and without emotion. Experienced professionals oversee strategy, risk management, and changing market conditions. Our clients aren't looking for excitement. They're looking for consistency, transparency, and peace of mind. Our clients want growth, but not at the expense of control. ATN was built on the idea that real, automated income should simplify your life, not add more stress to it. If you agree with that and are interested in learning more, there should be a link to speak to us in the description of this video. Now, let's get precise about what a liquidity trap actually is. In simple terms, liquidity means how quickly you can access your money without significantly affecting its value. Cash in a savings account is highly liquid. A commercial property in a slow market is not. A liquidity trap happens when investors are stuck in assets that cannot be easily sold, redeemed, or converted to cash without major loss. This can happen for several reasons: lock-in periods, withdrawal restrictions, thin market buyers, market stress conditions, structural fund rules. During stable markets, investors rarely think about liquidity. During stress events, liquidity becomes everything. In 2023, we saw regional banking stress expose liquidity mismatches. In 2022, bond markets experienced historic drawdowns while many assumed bonds were safe. In private markets, redemption gates became more common. Liquidity risk is not theoretical, it is structural. Several macro trends are increasing liquidity risk right now. First, global debt levels are at historic highs. Governments are issuing more bonds. Corporate refinancing pressures remain elevated due to higher interest rates. Second, interest rates have structurally shifted higher compared to the decade after 2008. When rates rise, bond prices fall. Investors who assumed bonds were stable income vehicles saw double-digit declines in 2022. Third, private credit and private equity allocations have grown significantly. Many investors moved into private markets seeking yield. However, private structures often limit withdrawals. Fourth, real estate markets in certain regions are experiencing slower transaction volumes. When transaction volume falls, liquidity declines. Finally, geopolitical tensions and economic uncertainty increase volatility. When volatility spikes, liquidity can dry up quickly. This creates an environment where access to capital matters more than ever. Liquidity is no longer a secondary concern. It is a primary structural consideration. Many investors believe they are diversified, but diversification does not guarantee liquidity. Let us look at some examples. Target date retirement funds adjust allocations over time. However, during market stress, both equities and bonds can decline simultaneously. That reduces flexibility when withdrawals are needed. Real estate investment structures can experience slower redemptions during downturns. Private income funds often advertise stable yields, but include withdrawal windows or redemption caps. Even certain bond funds can experience liquidity stress when underlying securities become harder to trade. The risk is not always visible in normal conditions. Liquidity problems appear during stress cycles. For investors near retirement, this becomes critical. If you need income during a downturn and cannot rebalance efficiently, you may be forced to sell assets at depressed prices. This is how temporary volatility turns into permanent capital damage. Volatility is price movement. Liquidity is access. They are not the same. An asset can be volatile but liquid. An asset can appear stable but be illiquid. Sometimes the most dangerous investments are the ones that look calm but restrict flexibility. Sophisticated portfolio construction balances growth exposure, income generation, liquidity access, risk controls. Liquidity gives you options. Options give you control. Control reduces forced decisions. This is where structure matters. Inside Automated Trading Network, Clients operate through their own regulated investment accounts. They maintain ownership of their funds at all times. They control deposits and withdrawals. The technology has permission to execute trades only. It does not take custody of capital. There are no lock-in periods. That structural design directly addresses liquidity risk. The goal is not only performance. The goal is adaptability. When markets shift, positions adjust according to predefined risk parameters. Liquidity remains intact because the capital remains inside the client's own account. That distinction is important in an environment where access to funds can become constrained in other structures. Automation should enhance flexibility, not restrict it. If you want to evaluate your own liquidity exposure, ask yourself, can I access this capital within days if needed? Are there withdrawal penalties? Are there redemption gates? Am I relying on one asset class for both growth and income? What happens if markets decline for 12 months? Liquidity planning is not pessimism. It is preparation. In 2026, preparation separates reactive investors from resilient ones. The liquidity trap is not about fear. It is about structure. In uncertain economic environments, flexibility becomes a strategic advantage. At Automated Trading Network, the focus is on disciplined execution inside your own regulated investment account, where you maintain full control of your capital and the system operates within clearly defined risk parameters. If you would like to understand how that structure works and whether it fits into your broader portfolio strategy, you can find more information through the link in the description. Take time to review it carefully. And if this discussion helped you think more clearly about liquidity risk and portfolio resilience, consider subscribing and turning on notifications. This channel is built for investors who value structure, transparency, and long-term survivability. I will see you in the next video.